Hello, everyone, and welcome to another episode of Passive Income Doctor. And today we have a special guest, Jason Hugo, who is a director at Bluerock. He's a personal and business insurance specialist, helping businesses, medical professionals, executives. Welcome to the show.
Great. Thank you very much. It's great to be here.
Yeah. First of all, can you tell us what you do and what a typical day looks like for you?
Yes, I lead the personal and business insurance team at Bluerock. So I've got a team under me as well that I look after. And for me, most of my days is client meetings. So spending time with existing clients, I'm reviewing their policies, policy anniversaries. So any sort of changes in their life, we sort of look at how that impacts their existing insurances, and also meeting new clients. So understanding their lifestyle, the unique situation, how we can actually assist them either reviewing their existing insurances or do they need some changes there as well. Part of my day is also advice formulation. So one thing we love to get into is the research and reviewing existing policies, particularly right down to the definitions. So that's a big thing for me. So we spend quite a bit of time in that, and also working through other partners inside the Bluerock group.
Yeah. So let's jump into it. Like, when should a doctor or anyone really consider taking out, personal insurances? It could be income protection, TPD, trauma insurance.
So I always say income protection when someone starts working, and particularly if they become reliant on their income, whether that's someone's still at home or they're out getting their own place. And the other thing we say with insurance, it's good to get it early while we're also healthy. And as we'll talk about, yeah, with insurances, as we move through life, and the insurance underwriters start to look at a bit more our medical history, and they can apply exclusions as well. So it's always one, the income protection as soon as they start working, and let's get that up and running. Um, when we talk about the other insurance, whether it be life cover or total and permanent disablement, that's really when an event triggers the need to it. So if I've got someone who's 21, still at home, probably not a real need, but if they've sort of bought their own property, they've got a partner, they've got kids, or anyone's financially dependent on them. So if anything happens to them, we've got to look after some, whether it be their kids or partner, etc., like that. That's where it's really important to sort of start getting considering the life insurance or different type of insurances.
Yeah. And for those of our listeners who are not sure what exclusions are, can you give us kind of a general definition and what might some common examples be?
Yeah, so insurance are always about mitigating risk. So with policy, so I'm a perfect example. I have a lower back exclusion on my income protection or part of my income protection. And that's purely because I get osteo work on my lower back. So the insurers go, okay, from this particular point in time until they have to keep offering the policy terms and conditions, so income protections to 65, they say, well, right, you're getting treatment on your lower back, therefore we're going to do an exclusion on that. Now, bearing in mind, that is if that my back continues to get worse where I cannot work. One thing that's really important for people to understand is they have what's called a comfort clause. So if you cannot work due to back injury that's caused by something different, and we always say, example, a motor vehicle accident that's hurt my back, therefore it's likely that I'm actually going to get a claim paid. So it's more, it just doesn't get worse like that. And the biggest one we've got at the moment is mental health,
Mm.
which is a high area of claims. So people are going through currently a mental health plan. It's likely they will get a mental health exclusion on their policies.
Mm. And some of the online forums, some people say it seems like female doctors seem to be hit with higher premiums. Like, is there? I know age is obviously influenced. Like, is kind of gender or whether you work full time, part time, things like that play a role as well?
Yeah, absolutely. So everybody's assessed individually. So if we look at females, males, so males are more expensive for life and TPD cover, but females for income protection and trauma cover are more expensive.
Mm.
Um, and there's a couple of reasons why. So income protection, so we look at that is, so we look at the claim statistics that the insurers look at is tend to be on claim more than males, and also breast cancer. And that's probably the biggest trigger point that we do see for trauma cover claims. So breast cancer is one of the most prevalent claims that I've had, and also been on claim for a longer time frame. Through the treatment program as well. So that's really which starts the initial premiums. Age base, yes. So anyone in the early 20s pay a higher, and as we sort of get to our late 20s, premiums start to dip down a little bit. And then as we get through our 40s and up into their 50s, like me, our premiums really start to go off. But generally, when people get into their 50s, they start to reduce the need for cover as the family gets older, the kids get older, the mortgage gets less as well. So there's a reduced risk, which means that reflects in the insurance requirements moving forward.
Yeah. And we should probably have defined for some of our listeners who are not very familiar with income protection, like what exactly does it do? And, does it pay you until a certain age and, waiting periods and things like that?
Yeah, so income protection effectively is there to support your family if you're unable to work due to injury or illness. Okay, so there's two ways we look at that. So before October 21, policies used to pay up to 75% of your income, including the super component. From that date, we had APRA regulate income protection. So now it's 70% of your salary, and there's a separate super component as well, but it's a little bit different than what it used to be there as well. Now, there's some key features. So the first thing is the waiting period, which can be 30 days or 90 days. And that's what we say from the time you can't work, that's effectively when you're on your own. So whether it be 30 days, and we have clients who have, whether it be high level of sick leave or cash in the bank, we can go out to 90 days. And that's really important because the difference between a policy with a 30-day waiting period out to 90 days can reduce the premium by about 40%. So that's a big one. And then we also have what's called the benefit period. And that's the maximum time frame that the policy will continue to pay if you can't work either fully or partially due to the injury or illness. So, and generally we used to do age 65 because that was traditionally what people worked to, although we're starting to think a little bit differently about that. And that's purely because income protection premiums, particularly some of the older policies, start to get quite expensive. So clients are coming to us and go, well, okay, we need to start looking at options. So we're starting to sort of think, okay, well, maybe we look at a 5-year benefit period, depending on their occupation. So, and the reason is this, us white collar workers, if I'm off work for 2 years or 5 years, it's going to be something pretty serious that stopped me working. So therefore, I might be to that total disability. Policy might be able to claim on that as well. So we're really starting to look at it a little bit differently over really the last 12 months as income protection premiums are starting to really take off and skyrocket.
Okay, something for me to look forward to as well. And I know I took out my income protection during my intern year, coming out, and also I was looking to purchase my first investment property as well. And at the time, I think it's called, is it agreed endorsed policy where it's a fixed amount until say 65 but these kind of no longer exist. Is that right? If you can share with our listeners.
Yeah, so when we look at the monthly benefit, and this is really impacts at time of claim. So we've got agreed value, which means at the time of claim and endorsed, because you still see some different agreed values because they haven't been financially endorsed. Little funny thing of the industry. But at the time of claim, it means that you don't have to show proof of your income to support the monthly benefit. Okay. The other one, which is called indemnity, and there's various types of that. So some of the older policies, I mentioned the pre-October 21, it could be the best 12 months over the previous 3 years to disability, and that had to support your monthly benefit. As I mentioned, the 75% of your income and the 70% of your income. Many years ago, when we used to do the agreed value, there wasn't a significant difference in the premium between the agreed value and indemnity. And because indemnity ceased back in 2019, looking at that, but before the October 21, premiums are really starting to increase significantly there as well. And the reason for that is there's no longer new clients coming to those policies. Those policies are still paying out claims. Therefore, they've got to cover the cost of claims, which means premiums are going up there as well. So from October 21, all policies were indemnity, okay, which means at the time of claim, you have to prove your income over the previous 12 months supported the monthly benefit of that 70%. If it didn't, it could mean that you will only get paid the amount that your income in prior to the date of disability of that 70%. So, for argument's sake, if your income was 200,000 and the monthly benefit supported that, you're absolutely fine. But if your income was 100,000, therefore, at the time of claim, you're likely to get less. So that's something we are really mindful of. And when we do annual reviews for clients, we really sort of check, has there been any changes in your income or circumstances? Because, we don't want people to be overinsured because, you don't want to pay premiums. They're high enough to pay for something you're not going to get. So that's how we work with it with our clients.
So is it now it looks at the last 12 months, is it? So if you went on like a gap year travel or maternity leave, then that's going to affect you, right?
Yeah, absolutely. And look, and there's two good points you brought up there with 12 months. So if we get clients who sort of take 12 months off, and I've got one now who's going to travel around Australia. So for 12 months, their policy still covers them based on their own occupation as an assessment to inability to work in their own occupation. Anyone taking 12 months or more, then it starts to change definition. So that's the first thing we've got. And there's a second thing which you've actually just brought up and saying, okay, what's it look like from a claims point of view if they were off work for longer than 12
Mm,
months, whether it be that. And some exceptions can be on sabbaticals and things like that when, we sort of get a lot of medical clients go overseas and do further training
yep.
or in Australia. That's absolutely fine. So there are little things around that, but as a general rule, we need to be careful anyone taking that time frame off.
Mm, okay. So that's income protection, and yeah, now it's in indemnity, as you said, looking in the last 12 months. And is it payout? Is it maximum 70% of
70%, that's
of
correct,
your
yes.
income? Yep. Okay. No
Yes.
worries. Now, total and permanent disability insurance. I know some people are not a huge fan of it. Some people say you should take it out and make sure you select, own occupation.
Yes.
Obviously, talking generally, like, well, what are your thoughts?
It's been the one in the industry discussed for many, many years, and I've come across some advisors who just don't believe in it. Look, my view, it does need to be formed part of your insurance plan. So we look at that. So total and permanent disablement is a lump sum payment if you're unlikely to ever work again. And as you mentioned, own occupation, there are some any occupation definitions, and there's sort of sub definitions in that as well. My preference is always own occupation. If I look at a medical specialist, someone who's a surgeon, you say, well, you've injured your hand in an accident, therefore you can't do surgery and perhaps ever again. So therefore it's likely to be paid. If it's any occupation, they say, okay, unlikely to ever work again in any occupation by education, training, or experience. Although the experience does give us that little bit of safety net if you've been doing your job, so you have 5, 10 years, the same sort of job. So that's probably okay. Where we're starting to see some issues, if we get some of the industry funds where they change the definitions, they say, okay, well, we can consider any further retraining and reskilling that we think is reasonable. That's a term the lawyers love, and we have lawyers in Bluerock who sort of look at that and they rub their hands together. That was a claim type of thing there as well. The other thing that we see with TPD is we say unlikely to ever work again. We see some policies that are totally unable to ever work again.
Mm,
It's a subtle difference by sort of saying, and to your people listening here, they'll know more than I do about signing off. And is someone totally unable, or is it likely they'll ever work again? It becomes a very tricky one there as well. So whilst we've got the any and own definitions, there's all these sub definitions under that.
mm,
My point of view, TPD, look, if someone's got income protection, I like to have the safety net of saying, you know what, if you do go to totally unable to work again, you want the mortgage cleared. Because, as long as the family home's protected, it's paid off, everything's probably going to be okay if you still get the income stream from your income protection. But
okay.
everybody's different. We look
Yeah.
at everyone differently, and also the cost, because I'll happily admit that if clients going to be, look, Jace, this is all great, but the premium's a little bit high. TPD is generally the first one I reduce backwards because they've got that safety net of the income protection as well.
Yeah. And then the trauma or critical illness insurance. I think I read a statistic somewhere that maybe this is the one that's most commonly claimed. Is that right? And then possibly that reflects in the premiums as well, I would imagine. What do you think about trauma insurance? When should a doctor consider it, and how much to insure for? I know some rules of thumb might be like cover for 3 months off work, and yeah.
To me, it's the most important one. I mean, look, together with income protection going through, because that's where our claims have been. So I've been in this role for nearly 20 years, and I've unfortunately had a lot of claims, and cancer's been the major one. I'd say 80% plus of claims has been for cancer as well. And it's more looking at the reasons why it's so good, because if I look at TPD, unlikely to ever work again, so that's based on an opinion. Income protection, signed off, unable to work for the next month, etc., like that. A bit better than TPD, but it's still opinion based. Trauma cover, or critical illness as it's sometimes called, is purely based on a medical definition. So you meet the medical definition of cancer, you meet the definition of a heart attack.
Mm.
I've had ones like bacterial meningitis, but they're the main ones that, yeah, where everyone says the cancer, the heart attack, and stroke. Where I sort of start the recommendation is, first thing is the provision for medical expenses. So unfortunately, everyone's going to have many claims, and as I said, your doctors know a lot more than I about this than I do. Sort of, immunotherapy and things like that. So the out-of-pocket cost for cancer treatment is the number one thing. The second thing is we work in a part depending on what their sort of family life may be. So you might say, okay, whilst my income protection pays only 7% of my income, my current budget is that I'm spending all my income. Therefore, if something happens to me and I can't work, there might be a bit of a gap. So we might need to do a top up of the income protection. Because bearing in mind, if someone's going through your chemo, etc., like that, income protection will pay. That's absolutely okay as well. So we sort of look at that particular part there as well. Also for high income earners, because whilst it's 70% of your income, it's up to that, the first 300, depending on the insurer, then the next 250 is 50%. Over that, it comes down to 30%. So when I start seeing medical specialists earning the higher income, they go, well, hang on, what we can get for income protection may not pay for their lifestyle. So we sometimes use that as a top up as well, purely for the high area of claims coming through there as well. But that's when we look at each person's personal circumstances. But absolutely, it has to be a core part of everybody's insurance plan. And you're spot on. So if you look at, say, the premiums, life cover compared to trauma cover, a significant amount more, purely because, once again, that's where the claims are and what's paid out.
Yeah. And what about stepped versus level premiums? No, it's a very topical conversation.
It sure is. It sure is. So if I look back 15 odd years ago when I first started, so, step premiums and the level premium, the difference might have been about 30%. And what you call the break even for the community, if I can ever say the word, used to be about 7-8 years. So anyone in their 30s, trauma cover, income protection, we used to always do level premiums. Life and TPD, I typically haven't done level premiums because if I look at what we cover, whether it be the mortgage, the school fees, ongoing expenses, it's typically a reducing need, the life and TPD cover. As people pay off their mortgage, we reduce the need. So therefore, I've never seen a need really locking it in, unless I've done some big buy-sell agreements for some younger people and they say, look, we're going to have this for 20 years. Where we're looking at now is that's really sort of changed. And there's two key reasons. The break-even point, we're talking sort of 16 to 18 years for the step versus level. So I can't see really any clients where I go, that's a good idea, because once again, anyone over that time frame is going to build their wealth. So the trauma cover needs may sort of drop off. And income protection, I sort of see clients, whether we go start at 30 days with a waiting period, then we push it out to 90 days as they build their wealth. And as time goes by, they build their super, they build their assets, passive income and assets like investment properties. You sort of go, well, I'm getting in my 50s. I probably don't need to cover all these big expenses of the mortgage, and the school fees. So you start to go, well, maybe we don't need that anymore. And then you overlay changes with governments, I won't say interfering, but sort of changing our industry, as we've seen over the last sort of 5-6 years with the life insurance reform and the APRA reforms. And I start to formulate whether it's needed. The other biggest thing, and we're seeing this with clients with existing level premiums, is level ain't level anymore. We're seeing insurers actually increase level premiums. And I've seen some really bad ones of 30-40%, and clients going, whoa, what's going on? Or clients coming to us, we took this out and our level premiums are going up. What do we do? How do we work through this, Jason? It's so from that point of view is, as I mentioned, you got the 16-18 year break even point, but that's actually probably going to be along with an increase in the premiums as well.
Yeah. That 16 to 18 year, I assume that's like a cumulative, right? Like cumulative cost of all the premiums added up.
Absolutely.
And is it indexed for inflation as well? Or sorry, bit of a technical question.
Yeah, it's interesting. So generally when I do the analysis, I don't do that. But when you work it out, so once you start looking at that, if you look at the indexation from the income protection, it actually starts to get a bit worse.
Yeah.
Because you've got to think every year. So, when you take the policy, the level premiums are set at that. But then the next time it's set at the next year, then the next year, then the next year. It's for my mind, it just does not make sense anymore.
Yeah, yeah, that is interesting. When I think when I was presented step versus level, probably about 7 years ago, yeah, I think the break even was about, yeah, 7, 8 years they might have presented to me. So when I was 23, I was
Yes.
like, oh, we'll do level. But
Yes.
but I guess insurance is always a evolving space, and yeah, as you said, the government had to step in and kind of force them to raise the premiums to I think in their words to ensure the sustainability of the industry.
Absolutely, was losing too much money. It looks something like 3 billion over 5 years in income protection,
Wow.
so not sustainable.
Yeah. And with, there's a few insurers out there, Clearview, Tau, Amy, Suncorp, Zurich. Is there any, well, obviously we won't say anything bad about one particular company, but like, is it they're all kind of used, and is there any nuances between these companies or?
So, but look at it now. So we're down to 7 insurers. We've had a few amalgamations and mergers with insurers, and that really stemmed from the reforms the government did with the significant reductions in new business being written, dropped it to about a quarter of what it was. So if I look at the major ones, so where we're talking, we've got the your TEL, your Zurich, which is the one path group, so the AIA, your Clearview. There's not a huge difference in the actual policies anymore. And it used to be the subtle differences with the income protection with all the optional lectures. But from October 21 with the reforms, that sort of pretty much made everybody the same with some subtle differences that they all sort of offer there as well. Life covers life cover, TPD's TPD, and we look at trauma cover, there's probably some subtle differences, but your core areas of claim probably stay the same. So for us, it's interesting that it's more comes down to the premiums, both initial and the long term that we look at as well. So when we do formulating recommendations, we look at initial premiums, and then we sort of say, okay, this cover's kept for 10 years. What does the forecast by the insurer look like they're going to be in 10 years' time? Because nobody wants to get big discounts up front, and in 3 years' time it becomes unaffordable. And unfortunately, some insurers are still playing that game. So we look through that to because try and make sure what's in client's best interest for the long term as well. Coming through from a claims point of view, all the retail insurers, they're all absolutely fine.
Okay.
I've had many claims, as I mentioned before, unfortunately, and yeah, we handle that internally here in Bluerock, and virtually every claims goes through that we know of. So it's quality policies.
Yeah, I guess that also would probably speak to having that support, if a doctor or person's going through this stressful life event, having this insurance is really like a safety net. So can you share with us then, some case studies? I think you mentioned 80% or so is related to cancers. Is that right?
Yeah, that's probably been the biggest area of claim. Yeah, it's the tougher part. Really, is the toughest part of our job when we do claims. But once again, that's what I do. So, look, a common thing I can give one story. I think it was my first claim. Mid-40s, she had breast cancer. Professional executive. Whole family relying on her income at that particular point in time, and she was off work for 14 months, going through the chemo and the various treatments, immunotherapy. And when I caught up with it at the end, and this is it's really interesting because we can sit down with a client and sort of go, okay, this is what we saw the need. We do a needs analysis to say these are the needs for insurance. This is what we're putting in place to sort of cover. But after a claim, when you sit down with the client, sort of understand exactly what they were using the money for and what the purpose of it. In this particular case, she just said to me, she said, look, straight out, if I'd only had the income protection, the trauma cover, we would have lost the house.
Hmm.
Because so reliant on her income, which is quite sad. And that's sort of been a tough thing and a common thing that clients have sort of said to us, we put in place for this. That was the exact sort of reason that we had. And I said, unfortunately, I have too many of those claims. So that's where it's really important that we sort of look at each client's personal circumstances and say, okay, what's the actual financial need for insurance? But then we work through and say, what the premiums look like. But a different one I had last year, it was unfortunately a client had brain cancer, which became terminal. And when we set up the insurance, help pay the mortgage, help do this, and help sort of keep the kids' education. And because she was terminal, so less than 24 months to live in the insurance industry, he's just going to go, Jace, that's all irrelevant now. because I can take 2 years off work to spend with my wife. And yeah, that's the sort of tough part of our industry. But once again, that's why I do what I do. So, yeah, I mean, clients are sort of, you can help them at the important time with insurance.
Mm. And that last one, so the terminal diagnosis less than 24 months, was that so claimed on, was it income protection? Was it claimed on the life insurance, or no, it might have been trauma as well, or
Yeah, so initially it was the trauma
yeah.
because it met the cancer definition, and then it became to the point where the doctors have diagnosed her as terminal, and so that was the life cover.
Yep.
So life cover being life cover, most policies have terminal illness. Some policies have a 12-month time
Yep.
frame, but majority nowadays under the super rules have 24 months
Okay. And it
time
sounds
frame.
like
So
it was able to then from that claim money to then pay off the mortgage and other things, that sort of thing. Is that right?
yeah, so that was the initial plan. But with her husband, he's just gone, Jace, you know what? I'm actually going to use it to spend 2 years, well, what was
Oh,
left with
okay.
my wife, just to sort of travel
Yep.
and to tick off her bucket list.
Yes. Yeah.
And that's what they got to do. And yes, there was some left over to help with the
Yes.
mortgage, but that was the most important thing for them.
Yes.
So we can work out when the needs analysis what clients sort of needs, but it's that sort of thing that we and admittedly I've started to change my philosophy about insurance after claims like that as well. Sort of, unfortunately, when I get the feedback, it's like, okay, maybe I need to think about the way I do things for clients as well,
Mm.
based on the feedback as well. So it's an ever changing requirement.
Yeah. So it sounds like the majority is, yeah, kind of maybe the trauma insurance and maybe some life insurance. Have you had
Yes.
any case studies of income protection claims? Maybe even someone younger and I guess, yeah.
Yeah, so I've had a variety of them. So income protections, I've had clients who haven't had trauma cover, and then going through cancer treatment, so the income protection pays because they cannot
Okay.
work. I had a young fellow once, bacterial meningitis. That was as well. So he was very ill there as well. They're probably the sort of the main ones. Unfortunately, clients have had accidents. So I've had a couple of clients hit by knocked off their bicycles while
Mm.
riding, so they're out of action for 6 months. And that's where some of the older policies are good, where they had a thing called specified injury. So if
Yes.
you broke an arm 1 month, you broke a leg 2 months. Just had a client who broke his hip, so he got paid 3 months benefits, and that's from the start of the policy, not the waiting period.
Oh.
Um, and that's where they're quite good because particularly people who are self-employed, it's difficult to prove
Mm.
loss of income depending what it was. And the insurance goes, okay, there's the 1, 2, 3 months, whatever that may be. You don't have to prove your income. And then once that sort of time frame's finished, then we've got to prove inability to work, loss of income. So great features, no longer available post October 21, but unfortunately that's where those older policies are starting to get a little bit more expensive because they've got these great features
Yeah. And in
as well.
those cases, like the bacterial meningitis or broke the hip, I assume eventually, maybe, I don't know, 1 to 2 years, we're able to go back to work. Are they then able to get the policy reinstated, or do you have to take out a new policy, or
Yeah, so income protection, the policy continues right through to the cancel, which is depending on the policy 65, is the most ones as well. So the good thing about income protection is it's not an all or nothing policy. So perfect example, we've got clients who might go through some treatment, so they're off for 12, sort of 14 months, and then they might ease back into the workforce. Okay, so as long as there's still a loss of income, so
mm,
the insurers say, okay, well, you've got a loss of income, you can earn the maximum of 75% of your income or 70% with the new policies. And let's say, for argument's sake, you're getting paid 50% of your income. Therefore, there's still a loss or a gap there as well. So insurers can cover you there as well. And depending on the policy, if you're back at work and let's say whatever the condition may have been has flared up again, so you're off work again, a lot of them waive the waiting period as well,
oh, okay.
or something going through there as well. A little bit different with trauma cover. So once a claim's been paid,
Mm,
it brings assume the whole amount's been paid. It wasn't a partial benefit. The sum insured goes back to zero. Some policies have what we call trauma reinstatement, which
mm,
is something we always recommend. So I've had clients, particularly clients suffer something young, goes back to zero. So after 12 months, it can be reinstated.
okay.
It just excludes the original condition. So I've had people with cancer, therefore going forward, they can't claim for cancer along those lines as well. So the good news is there's still some sort of cover in place there as well.
Yeah. And one of the questions is, I guess, is there any cost to the doctor utilizing a service such as yourself? I believe you guys get paid by the insurance companies, and and how does it work from that regards?
Yes. So up until about 2017, when we had the life insurance reforms and the change in the commission, it used to be various. So it used to be between sort of 100 and 140% of the initial year's premium initial, and then it might have been 10% ongoing. Now it's all been regulated, so all new policies pay 66% of the initial for 12 months premium, and then 22% ongoing
Hmm.
coming forward. Yep. So the reason the government brought that in was twofold. One, because they were saying, well, if an insurance company's paying a higher commission than another firm or something like that, they might be sort of say, well, okay, I might put the client with that one. And they reduced their sort of initial commissions. There used to be a thing in the industry everyone used to get concerned about with churn. So some advisors moved to one insurer in 2 years, and they're around like that as well. So they tried to stop that sort of behaviour as well. But yep, all insurers pay the same amount these days.
Yeah, no worries. Thank you so much for coming on and giving our listeners a good brief and update regarding insurances. What kind of closing thoughts would you leave with our audience? Say there's some doctors out there that, too busy, haven't gone round to it, haven't thought about it. What would you say to them about the importance of insurances, personal insurances?
Yeah, look, if I look at that, if I say to anybody, if anyone's financially dependent on you, or if you were unable to work, what would that actually mean to your circumstances? At least have a discussion about some type of insurance. The way we work through is we look at what the ideal levels of cover are, but we also say to clients, we work together to say, where are you happy with what you cover and what you're sort of paying with premiums? The other thing, too, we actually see a lot of clients who are overinsured because they're too busy to review it over many years. And, as I said, the mortgage decreased, the school fees have gone. And so we've got clients come to us and we say, okay, you've got these great policies with the definitions, so we need to keep those. But, we're half the premiums by just reducing the requirements, saying, what, well, your mortgage is half, so automatically we drop it. So that's actually just as important with everybody really saying, what, don't forget to review it with changing circumstances because, what, you don't want to be overinsured. Premiums are getting too expensive these days. So, and that's a big thing we're seeing right now.
Yeah. Thanks again, Jason, for coming onto the show. If our listeners want to find out more about you or Bluerock, what's the best way to get in touch?
Yeah, so my team and myself are always happy to help, whether they want to reach out to us via an email or just give me a phone call. That'd be fantastic. And as I said, we don't charge to have a conversation. We're always happy to help.
Yeah, no worries. And I'll leave some links in the show description below. So thanks everyone for tuning in to another episode of Passive Income Doctor. See you on the next one.